The Dow is taking a pause for breath after a six-day winning streak. This as the market weighs up increasingly dovish expectations towards the Fed against unresolved trade tensions between the US and China. So where next for the major averages, and how much longer until the US economy starts to falter? Here to discuss is Daniel Lacal, Chief Economist at Tressis. Daniel, good to see you as always.
Thank you very much.
Let's start with the Fed, because of course we've got this rate decision next week. The market's looking for sort of 15 to 20% chance of a cut. How does that coincide with your expectations for next week and the full year?
I don't agree that we could see a cut as early as next week. I think that the Fed does not need to cut rates at this moment. Neither employment nor inflation. The PPI data that came out this week was actually decent. Therefore, there's absolutely no reason for the Fed to cut rates. I think it's more something that the market wants the Fed to do in order to continue to cement the inflated bubble of equities. However, what I think is that the Fed needs to build tools and needs to keep the powder dry in case the economy starts to really weaken. There are some signs there, but it's not yet something to worry about.
So if we're not looking for a cut next week, what is it that we should be focusing on in the meeting in terms of the presser? I mean, if you were there, what questions would you like answered?
Yeah, well, I think that the main question is about inflation, no? Because unemployment is fine. Unemployment is well within the target of the Fed. Growth as well. In general, all of the economic figures are okay. So everything should tell us that the Fed would be in a position to normalize, to maybe not cut rates, but actually increase rates, hike rates, no? So the question is, why are they so concerned about an inflation rate that is not that bad either? And I think that is one of the things. What should we think about? I think that they will continue to have a dovish message. I think that what the Fed has been successfully passing on to markets is that they are willing to take action, but it's not the time yet. So probably we'll see, some elements of what other tools they could use in case of a downturn, whether they would be considering QE, all these things. But I think that in terms of action, they are not going to take any decisive action right away.
And do you think we should be cautious about the pace of change that we've seen from investors in terms of their expectations towards the Fed? Because it wasn't long ago that we were looking for up to 3 hikes this year, and there's been this major turnaround towards potentially 3 cuts. So how do we kind of interpret that, and what's driving it? Because, like you say, it's not really the data. Yeah,
I think investors want central banks to be extremely dovish, and investors like easy money. We all do, but it's dangerous. It is very, very dangerous to play this the worse the better, the worse the data, the better for us in terms of being more exposed to cyclicals, more exposed to let's say emerging markets, things that are very, very aggressive in terms of beta. So the general sense that I get is that investors have gone from being very aggressive about normalization of policy to extremely optimistic, at least optimistic in the sense of equity markets or of risky assets in terms of the policy. I think that central banks cannot just go out and give the message that the economy is doing well, that unemployment is improving, and that the growth is within expectations, and at the same time go ultra dovish. Because then that would send a very negative message actually to long-term investors that would say, hey, this does not compute. You cannot say on one side that things are going extremely well and at the same time be extremely dovish. Therefore, I think that investors are probably too aggressively exposed to cyclicals.
So what sectors should we be looking towards then, do you think, right now?
The way that we tend to look at the market is what is expensive and why. Bonds are expensive. safe or, let's say, less exposed to the cycle assets are expensive, but they're expensive for a reason. The reason why they're expensive is because the lowest risk assets, sovereign bonds, are monstrously expensive. So if central bank policy and monetary policy are going to continue to aim at governments, at sovereigns, issuing low-cost debt, then those risky, those sort of safer assets are going to continue to be expensive. Therefore, in terms of asset allocation, we always say, what is expensive will continue to be expensive, and what is cheap will continue to be cheap. So the movement every year we hear once every quarter that growth versus value has never been with a more wide level of disparity. Continue to be less exposed to, let's say, those supposed value sectors, because the value sectors tend to be what? Tend to be banks, unfortunately, nominal negative rates, not going to help the banks, definitely the European ones or the Japanese ones, and you should be at least more exposed to the sectors that are driving disruptive technologies and are driving the change precisely in these inflation estimates that we talk about.
So how much exposure do you think a portfolio should have towards the US equity market right now? I mean, you suggested that bonds were expensive. I mean, in terms of the markets, obviously we had a very strong start to the year. We had that pullback in April, May, and now it looks as though the US markets are back on track. So my question really is, how much longer do you think that will last?
Well, I think you should be longer the United States than other developed economies. And the reason being, this year we heard that, for example, that buybacks would stop. Buybacks are here to stay. This year we heard that the growth in earnings was going to be much weaker. It is, but it continues to be much stronger than that of the Eurozone, definitely than that of China or many other economies. And you also have a much more total shareholder return policy in most of the management policies, and this is very important. Therefore, if you as a minority shareholder are looking to be as close to the management's decisions, you're better off in the United States and in Anglo-Saxon equities, I would say, rather than in Eurozone ones, which, by the way, all of the growth that they have is usually comes from assets that have been acquired at massive multiples or with debt.
Now, obviously, you just pointed to debt. I know that you tweeted today about the fact that this high level of debt, particularly in the US, could pose a potential crisis. It was an article from the Wall Street Journal from back in March, but presumably you believe a lot of those points still very valid. Tell us about kind of the risks surrounding that indebtedness, particularly for the real economy in the US.
Well, what is the biggest risk? The biggest risk is that because debt is cheap, we hear too many times and we read too many papers and we read too many articles from mainstream economists saying that it doesn't matter. And it does. It makes the economy less dynamic. It makes the economy weaker, and it's a massive misallocation of capital from the productive sectors into the weaker, into the more, let's say, obsolete sectors. So there's a big challenge there. The other big challenge is that in the case of the US debt, but it's also very evident in the Eurozone, is that entitlement costs are rising dramatically. And the mandatory expenses in the budget are actually the ones driving the deficit. Mandatory expenses go through the roof. So discretionary expenses, even if you were the most hawkish type of government cutting everywhere that you could, you would still see rising entitlement costs. And no revenue growth is helping that, because the deficit spending continues to be there. You would maybe reduce slightly the deficit, but not a lot. Actually, as we saw in the Obama administration, deficits continue to be very strong. So the problem that we need to address is whether we want more dynamic economies or less dynamic economies. We know what happens when you get into the cheap debt problem. Is Japan. is a stagnated economy that constantly tries to stimulate internal demand via government spending or via stimuli, and then what ends up happening is that you don't get the growth, but you still get the debt, and it just becomes a sort of a negative downward spiral.
And what about sort of the outlook in terms of the risk of a global recession? Because we've heard a number of economists talking about this potential risk. Morgan Stanley, one of the kind of doomsayers, suggesting that we could have a global recession in less than a year. Others less pessimistic. Where do you stand?
I think we're more likely to see global stagnation than global recession, or at least what people perceive by global recession. I think that when I speak with people about global recession, they're thinking 2008. We're not going to have a 2008 moment. We're going to have a very, very slow stagnation process, because central banks are going to continue to pump the economy with more liquidity, and that liquidity is going to go to sovereign debt. That sovereign debt is going to continue to finance deficit spending in current spending, and therefore, as we said before, less dynamic economies. So it is unlikely that we see a sort of a crash type of 2008, but a very likely scenario is that we continue to erase growth estimates to a point that they become clearly recessionary, but not something that I would say doomsday, as you were mentioning before.
All right, Daniel, thank you so much for your time.
Thank you so much.
That was Daniel Lacal, Chief Economist at Tressis. I'm Victoria Scholar, and we'll see you very soon.